Last night, Bitcoin violently dropped to $63,626. The bizarre part, the Federal Reserve didn't even raise interest rates.
Right. They did absolutely nothing. Well, in terms of the actual rate, I mean.
Yeah, they just held it. But welcome to today's deep dive. We're looking at how the new Fed chair, Kevin Warsh, managed to crash the market by doing, nothing and flat out refusing to tell you what he'll do next.
Exactly. I mean, it's like he didn't just take away the liquidity punch bowl. He completely shattered it while everyone was drinking.
Right. So let's establish the catalyst here.
So the immediate catalyst was the FOMC voting unanimously, 12-0, to hold the benchmark rate right where it is.
Which is that restrictive 3.5 to 3.75% range.
Exactly. And, the market had that priced in. But what it didn't have priced in was the structural shock Warsh just introduced by basically dismantling how the Fed communicates.
Yeah, the dot plot inversion. I mean, back in March, a majority of the Fed was promising a rate cut this year, right?
Right. And now 9 out of 19 officials are projecting an actual rate increase before the end of 2026. And they pushed their inflation projections up to 3.6%.
It's wild. And Warsh's structural shift is the real weapon here because he refused to even submit a personal dot plot projection.
Yeah, he just opted out. He deleted the easing bias language from the official statement, too. I mean, he basically killed forward guidance entirely.
So going forward, the bank operates strictly meeting by meeting.
Completely meeting by meeting.
Since the actual interest rate didn't move a single basis point, is Warsh effectively, weaponizing uncertainty?
Oh, absolutely. He's shocking the market into cooling down without having to actually pull the trigger on a rate hike.
By removing the roadmap.
Right, because by removing the roadmap, he forces the market to price in risk at a much higher premium. He's prioritizing absolute price stability over predictable liquidity.
So he's letting the fear of the unknown do all the heavy lifting. And when Warsh forces the market to price in the unknown, that premium hits a non-yielding asset like Bitcoin incredibly hard. You're bleeding opportunity cost just by holding it when risk-free rates are anchored high.
Yeah, traditional prediction markets are already pricing in a 50.5% probability of an October rate hike.
Oh, wow. Really?
Yeah, so institutional capital looks at that math and realizes holding Bitcoin just becomes too expensive. I mean, they could be generating a guaranteed risk-free yield elsewhere.
Right. Which explains the immediate capital flight we saw. On June 17th alone, institutional players yanked $82.2 million in net outflows out of the U.S. spot ETFs.
It is a massive structural extraction of liquidity. And that fear isn't just in the spot market, it's bleeding directly into the hands-on traders in the synthetic markets.
Because the crypto markets operate 24/7.
Right, 24/7.
Yeah.
So funding rates on perpetual contracts on platforms like Hyperliquid, they completely flip negative. Short-term sentiment is just sprinting toward downside protection.
Wait, I want to push back on that a bit. If funding rates flip negative, short sellers actively have to compensate the long holders, right?
Yeah, they have to pay the longs to keep their positions open.
So there has to be a threshold where shorting just becomes too expensive. Doesn't that create a friction point where downside momentum exhausts itself? I mean, shouldn't that establish a natural price floor despite all this hawkishness from the Fed?
I mean, yes, the mechanics of negative funding do create increasing friction for short sellers.
Because they're bleeding capital just to stay in the short trade.
Exactly. But in the immediate term, the macro-gravitational pull, that massive extraction of liquidity driven by the Fed, it's just overpowering those micro-market mechanics.
But how long can short sellers bleed capital? If the Fed is just holding rates and weaponizing uncertainty, the physical spot selling eventually dries up.
Well, that assumes the uncertainty doesn't trigger secondary waves of liquidation.
Right.
I mean, the friction you're talking about definitely matters, but the macro dictates the overarching trend. The micro just dictates the friction along the way.
Right.
Warsh's policy isn't just a temporary shock. It's a whole new regime that values absolute price stability over the predictable liquidity markets rely on. The cost of capital is high, and the certainty of capital is gone.
So the core takeaway for you listening today is that the Warsh era has introduced an immediate structural squeeze on non-yielding assets.
Yeah. By prioritizing absolute price stability over predictable liquidity.
It's a permanent dismantling of forward guidance to trade on a strict meeting-by-meeting basis, which leaves us with a final thought for you.
Right.
If the Federal Reserve is permanently dismantling forward guidance, how will an asset class historically reliant on predictable long-term liquidity cycles adapt to an era of permanent macroeconomic unpredictability?
It's uncharted territory.
Something to think about as this meeting by meeting reality sets in.